Simplilearn. Your pace, your place.
Valuation of Debt Securities. Volume 5, Study Session 16, Reading 56. Fixed Income. Review. Welcome to Reading 56 of the Simplilearn CFA Level 1 tutorial. In the last tutorial, we identified the interest rate policy tools available to a central bank, described the yield curve and various shapes of the yield curve, learned the basic theories of the term structure, understood the spot rate and various yield measures, and explained how embedded options, liquidity and issue size affect the yield spreads. This session is on Reading 57 as prescribed by the CFA Institute Learning Outcome Statement, or LOS. We learned about LOS in the first session. Please go through the Learning Outcome Statement for a detailed list of learning outcomes. After this lesson, the candidate should be able to value a bond using both traditional as well as arbitrage-free approach. Agenda. The agenda of this session is to cover Reading 56 as prescribed by the CFA Level 1 curriculum. You can go through this reading from Volume 5 of the CFA Level 1 curriculum made available to you by CFA Institute. In this lesson, we will start by understanding the general principles of bond valuation. We will learn to estimate future cash flows and determine appropriate interest rates for discounting the future cash flows. We will also learn how to discount the expected cash flows and learn the traditional approach of bond valuation for a coupon, as well as for a zero-coupon bond. We will then learn the arbitrage-free approach to bond valuation. Lastly, we will compare the traditional and the arbitrage-free approach to bond valuation. As per the Learning Outcome Statement, after completion of this lesson, the candidate should be able to explain the steps in the bond valuation process. Describe types of bonds for which estimating the expected cash flows is difficult. Calculate the value of a coupon and a zero-coupon bond. Explain how the price of a bond changes if the discount rate changes and as the bond approaches its maturity date. Calculate the change in value of a bond given a change in its discount rate. Explain and demonstrate the use of the arbitrage-free valuation approach, and describe how a dealer can generate an arbitrage profit if a bond is mispriced. General principles of bond valuation. There are three main steps involved in the process of bond valuation. Step 1. To estimate the expected future cash flows coming from the bond, like the coupon payments and the principal payment. Step 2. To determine the appropriate interest rate or rate that we are going to use to discount the future cash flows. Step 3. To calculate the present value of all the future cash flows found in Step 1 using the interest rates found in Step 2. The sum total of all present values of the future cash flows is the value of the bond. We will look at each of these steps in detail in the coming slides. Estimating cash flows and determining appropriate interest rates. Cash flow is the cash we expect to receive in the future from an investment that we have made. These cash flows are affected by the change in interest rates in the future, since the changing interest rate environment affects the options embedded in the bond. Estimating the future cash flows can be difficult under the following scenarios. When the issuer or investor of the bond has the option to change the contractable due date for payment of principal, callable bonds, puttable bonds, mortgage-backed securities, and asset-backed securities fall under this category. When the coupon payment is reset periodically by a formula based on some value or values of reference rates, prices or exchange rates. Floating rate securities fall under this category. When the investor has the choice to convert or exchange the security into common stock, convertible bonds and exchangeable bonds fall under this category. The minimum interest rate that is required on an investment is the yield available on a default free cash flow, like in the US, the yield on the Treasury security. For a non-government security, the yield required is the yield available on an on-the-run Treasury plus an additional risk premium. Since each cash flow is unique, it is more appropriate to value each cash flow using an interest rate specific to that cash flow's maturity, rather than using a single interest rate to value all the future cash flows. Discounting the expected cash flows. Here we take a look at the method to discount the future expected cash flows. Given on this slide is the formula used to discount a future cash flow to find its present value. This formula uses as its inputs the future cash flow that is to be discounted, the interest rate used for discounting the cash flow, and the period from now when the cash flow is going to be received. When we have found the present value of all the future cash flows using the above formula, the value obtained by summing up all these present values gives the value of the financial asset. Let's take a look at the example where we need to find the value of a bond that matures in 4 years, has a coupon rate of 10%, and has a maturity value of $100. The bond pays interest annually at a discount rate of 8%. For solving this, we first identify the cash flows that are going to occur in the 4 years to come. The cash flow for years 1, 2, and 3 is $10. The cash flow in the 4th year will be $110, as it will include the principal of $100 as well as the 4th interest payment of $10. Each of these cash flows is then discounted to the present using the interest rate of 8% as mentioned in the problem. The sum total of the present value of all the 4 cash flows gives the value of the bond, that is $106.6243. When we plot the price of security with the discount rate on a graph, we see that higher the discount rate, the lower is the security's value. Valuing a zero coupon bond. In this slide, we look at how to value a zero coupon bond. The only cash flow involved in a zero coupon bond is its maturity value. The value of a zero coupon bond is found by discounting the maturity value of the bond with the semi-annual discount rate. Let us consider this example where we need to find the value of a 5-year zero coupon bond with a maturity value of $100, discounted at an 8% interest rate. The semi-annual discount rate is 1/2 of 8%, that is 4%. Using the formula, we get the value of the zero coupon bond to be $67.5564. Arbitrage-free bond valuation. In this slide, we look at the flaw with the fundamental approach to bond valuation and the method of arbitrage-free bond valuation. The fundamental flaw of the traditional approach to bond valuation is that every cash flow of the fixed income security is discounted at the same discount rate. Arbitrage profit can be made in this method by taking apart a security and selling off the stripped securities at a higher aggregate value than it would have cost to purchase the security in the market. The proper way to view a bond is as a package of zero coupon bonds whose maturity value is equal to the amount of cash flow and whose maturity date is equal to each cash flow's payment date. This method is the arbitrage-free valuation approach. Treasury spot rates are used for valuation in this method because the value determined using the Treasury spot rates does not allow for the generation of an arbitrage profit. Comparing traditional and arbitrage-free models. In this slide, we will compare the traditional and arbitrage-free value of an 8% 10-year Treasury bond. For all the cash flows corresponding to the 20 time periods, we will calculate the present value of each cash flow using the discount rate as well as the spot rate corresponding to the particular time period. When we sum together all the present values of the cash flows calculated using both the spot rates and the discount rates, we see that the two values come out to be different. The difference in these two values is the arbitrage value.